When our economy is in trouble, the federal government turns to the Fed to save us. In this video, I'm talking about why I believe that home prices across the nation are headed for a major decline and how our economy and all of us are affected by the rise in interest rates. Now, the Fed met yesterday to discuss the state of our economy.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down, and we're moving expeditiously to do so.
So, recent reporting had indicated that our inflation rate had hit an alarming 9.1% at the end of June, a rate that we haven't experienced since the severe economic recession of the 1980s, which was then compared to the recession of World War II. The 1980s recession was blamed partly on the Iranian Revolution, which caused a global disruption in oil supply, and fuel prices skyrocketed from 1979 until well in the 1980s.
The earlier surge in prices of crude oil and other commodities that resulted from Russia's war on Ukraine has boosted prices for gasoline and food, creating additional upward pressure on inflation.
Are we headed into another 1980s type recession? Look, we can all agree inflation's out of control. Now, the Fed wants to reduce the 9.1 inflation rate by 78%.
It is essential that we bring inflation down to our 2% goal if we are to have a sustained period of strong labor market conditions that benefit all. The labor market is extremely tight, and inflation is much too high.
If you've visited stores or tried to hire contractors or have gone out to dinner lately, you may have noticed that businesses are short on labor, and I've personally experienced a major reduction in customer service. This is telling me that businesses are struggling to hire help for whatever reason. I think that we can agree that businesses need employees, and thankfully, because we all need our jobs. The question is, when the Fed goes to slow down the rate of inflation, are we going to keep our jobs? So if people stop spending money, they stop going into businesses, this is going to affect the business directly. And what will this mean for businesses that are already struggling to make a profit? If consumers back off on their spending, will this mean that businesses will be forced to lay off?
This process is likely to involve a period of below-trend economic growth and some softening in labor market conditions.
We can all agree that prices have really skyrocketed over the last couple of years, and I think that we can also guess that it's been a lot more than the reported 9.1%. Now, guys, the real question that I'd like to ask you is, what do you think is going to happen to our job market as the economy starts to slow even more in an effort for the Fed to slow down the rate of inflation? If you could drop your comment below, I think that we all have something that we could learn from each other. Now, one of the ways that the Fed plans on reducing the rate of inflation is to raise the interest rates. And we were certainly expecting yesterday's rate hike.
Against this backdrop, today the FOMC raised its policy interest rate by 0.75 of a percentage point and anticipates that ongoing increases in the target range for the federal funds rate will be appropriate.
So this rate hike marks the fourth rate hike so far this year. And as Fed's Chairman Powell has indicated, they're prepared for even more rate hikes.
While another unusually large increase could be appropriate at our next meeting.
Unusually large increase? Many of you may now be asking, what does rising interest rates have to do with you, the economy, and employers? The interest rate that's being increased by the Fed is central bank's overnight interest rate. This is the interest rate in which commercial banks borrow and lend money. This affects us because consumers and businesses needing to borrow money will be paying even higher interest rates to do so. This affects all types of consumer loans, including our credit cards, auto loans, and much more. Higher rates also affect businesses that need to borrow money in order to operate. Many businesses need to borrow money from time to time for their operations to cover things like payroll and inventory costs. The viability of our businesses are very important because they provide us with our jobs, goods, and services. Now let's take a look at this chart from macrotrends.net. Now this chart shows how the federal funds interest rate is adjusted over the last 62 years and how the rates have adjusted with our historical economic recessions. What's important to note is that throughout history, these rates are raised to the point of a recession, and then they're lowered to stimulate spending once again. So the gray bars in this chart, they reflect the economic recessions throughout the years.
Recent indicators of spending and production have softened. Growth in consumer spending has slowed significantly, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened, in part reflecting higher mortgage rates. And after a strong increase in the first quarter, business fixed investment also looks to have declined in the second quarter.
As we're looking at this chart, you'll notice that when the coronavirus pandemic hit back in 2020, we experienced a short recession. So the Fed responded by lowering the interest rate to almost 0%. Now, in my industry, this sparked a rise in housing prices like we've never seen before. I mean, the price index almost shot straight up. And, what happened was mortgage rates went down to historic lows where you could get a 30-year fixed conventional mortgage at only 2.75%. So now let's just take a quick look at the 30-year fixed mortgage rate over the history dating back to 1970. As a result of the low mortgage rates in the last several years, this has caused, like I said, the home prices to just soar out of control. Now, with the increasing home prices and the rising interest rates, it's really made housing unaffordable for most home buyers. Following the Fed's interest rate hikes, the 30-year mortgage is now at a rate that we haven't seen in almost 15 years. And let me tell you that the recent rise in home mortgage rates has crashed home sales, and you ain't seen nothing yet. In my opinion, we're about to see home prices decline across the entire country for any sellers that need to sell now. Home price pressure is on. And now here are a couple reasons that I personally believe that home prices are going to crash all across the country. So reason number one, if you're buying a home today, your mortgage will be 30 to 50% more for the same loan than if you bought just 12 months ago. In many markets across the country, we've experienced up to 80% of the buyers have exited the market until home prices decline. And according to this economic report on marketwatch.com, mortgage applications activity drops for a fourth week in a row to the lowest level since February of 2000. That's 22 years ago. Reason number two is increased housing inventory causing more competition for sellers. According to this other MarketWatch.com article, across the nation, housing inventory has risen nearly 28% from March to June. Now, I can tell you that here locally, that article is proven outdated because we've even seen more inventory hit the market in July. So common sense tells us with more competition and less buyers in the market, sellers need to determine whether they're going to drop the price on their houses in order to sell now or whether they're just going to sit tight for the next 4 or 5 years. Now, I personally believe that across the country, on average, we're going to see a decline in home sale prices of about 10%. And in some markets, we may see a decline of greater than 20%. If you're looking to buy or sell and you'd like to discuss your personal situation, feel free to shoot me an email and we'll talk about it. I appreciate your time. If you like this video, you can let me know that you did by hitting that thumbs up. And I always appreciate, if you haven't already done so, smash that subscribe button, hit the alert bell. It will let you know every time I upload content. See you next time.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.